92% probability that the Fed is going to raise the Fed rate another quarter at this next meeting in June. So what does that mean? Rates are going up because this is not at all what we wanted. And I want to talk just for a few minutes about the debt ceiling, about the Fed meeting, about jobs report and unemployment. We have a lot going on this week. And then, of course, we've got CPI numbers coming out for inflation and the next Fed meeting. So I really want to bundle all this up together and talk about what does that mean for our market and interest rates, and you as a buyer, what opportunities might there be in this kind of market? I had a phenomenal conversation. It lasted about 45 minutes yesterday, talking to new first-time home buyers, a young couple who were looking at the opportunity of buying a home. Now, they've been looking for about a year, and Dad is going to jump in and also help. And they were trying to negotiate Dad's desire to get the best deal and their desire to get into home ownership. And how do they marry those in an environment where interest rates are still going up, home prices continue to have multiple bids? And have you seen the news? I mean, Wall Street Journal is calling for a housing bust again. I mean, come on. So what does all this mean? So where's the economy going? What is the interest rates doing? And what are the opportunities for you as a buyer? That's what we're talking about. So the economy, let's talk about that quickly. We've got the debt ceiling conversations and the X date. It's a really big deal. But then again, no, it's not. So the government has come up against this default date many times over. And you know what they do? They raise the debt ceiling. That's what they do. That's what they do every single time. And many times they do it without even a peep from the public or the politicians making it a big deal. Not making it a big deal. Just sweeping it, kind of continuing to go under the rug and raise the debt ceiling. And we all continue to move on and keep spending. I mean, have you seen the government debt today? It's intense. And it's certainly larger than it's ever been in history. And it's doubled just since COVID. Maybe it did triple. I don't know. It doesn't even matter. It's massive. The problem with just continuing to raise the debt ceiling is, at what point does the country become so indebted that it's impossible to pay down our debts, or to get to a position to where we can just have a budget, a zero budget, right? A net equal budget on a continued basis to support our children, to make sure that we continue to have services like Social Security, to continue to provide the governmental services, because we know that birth rates declined today at age 12. Those kiddos age 12 and under, we're going to see a lower population. Now, I continue to say that as a positive, because for the next 2 decades, we're going to have massive demand on real estate. But I know, as far as a debt ceiling goes, that at some point we're going to have to pay the piper. But right now, we continue to raise the debt ceiling, and that's what they'll do. The X date was June 1st. Really, now they're saying it's really June 6th. Some are saying June 8th. And at some point, we'll get through this. What is happening right now is you have both parties that are trying to get their positions advanced, and they are using this massive date as a tool by which they can make their political stance. The problem is both parties, at the sake of spearheading for their constituents, are putting us further at risk and in debt. The longer they wait, the more expensive it gets, because of the increased risk, there's increased yield. Speaking of yield, the 3% bond rate, or the 3-month bond right now, is over 5%. If you want to put your money in some short-term safe options, you should look at the 3-month Treasury yield right now. So we've got this X date looming. This week, we've got the jobs report numbers. We've got ADP. We've got the government BLS jobs report. And then we have unemployment. I will tell you that right now, with wages continuing to be strong, with unemployment actually dropped from 3.5 to 3.4% last month. Remember, going back to March 1969, that number has to come up. Wages have to soften. We have to see an advancement in the the ability to control wages and this wage spiral, which is continuing to put pressure on inflation. The Fed is going to have to see that in order to pull back on actually reducing the Fed rate. So right now, that's why the probability is up, because we're still seeing the March 10th inflation numbers really didn't do what we wanted them to do. Hopefully we'll see a little bit of a drop this time. We're still seeing an increase in owner's equivalent of rent in the PCE numbers. Those numbers showed an increase to housing, which we know isn't true, but we also saw an increase in the core, even minus housing. So it means inflation is being stubborn, it's being sticky. The Feds very well might have to raise the Fed rate by a quarter this next meeting. If they do, we know for certain that the economy and the bond market is not going to like that, and we'll continue to see higher rates for longer. Speaking of rates, we just saw this morning the 30-year mortgage rate nationwide average is 7.14, and that includes discount points. So buyers, what are the opportunities? We know we have a lot of news market moving reports coming out. We know that we have the Fed meeting right a day after the CPI meeting coming out in about 14 days. And then we know that the Fed is trying to hold the Fed rate higher for longer. What does this mean for you? What are the opportunities? Buyers, I will tell you, that conversation that I had for 45 minutes yesterday with the parent or one party to the transaction trying to get the best deal, and the kiddos trying to get into a home, trying to reconcile that. And I absolutely understand that, trying to reconcile that in this market with the headlines talking about the housing market and seeing some level of a collapse. Here's the deal, especially in the Denver market, and I cannot speak to every market across the country. Markets right now are very localized, especially in the Denver market. We do not have enough inventory to meet the demand, and we know that demand is going to be strong for the next 2 decades. I touched on that. The highest age group today is 33 years old. The average first-time home buyer is 34 years old. The second highest age group is 21 years old. We have massive demand coming down. We have limited growth in new builds and starts and permits. In fact, we have more starts for rent than we do for purchase on new builds. So we're going to have limited new builds. We have limited inventory because we have a lot of existing homeowners with tons of equity and locked in low interest rates. So here in the Denver market, we're not going to see a drop in values. Could we see a flattening of values? We could. In 2019, we saw a 2% increase in median home prices throughout the year. We could see a very low appreciation year. But here's the deal. When you're renting, you're paying 100% interest rate versus getting in at a 6.5, even a 7.14, which is the national average, even getting in at a 7.14, yes, you're paying interest, but you're also paying principal reduction. You're also building, even if it's small, equity gains. And remember, the equity gains are on the purchase price, not your down payment. Your down payment could be nothing because we have phenomenal down payment assistance programs, including the new Movement Boost, which goes up to $188,000 in income. All of these to say that the longer you wait, the longer until you start building equity and wealth, the longer before you start building financial stability and security. That jumping in right now is going to give you the little ticks up in appreciation. Doesn't have to be a lot to be worth it. It's going to stop paying somebody else's mortgage and start paying your own. It's going to get you in. And when and if the mortgage rates drop, and the probability is high, but the question is when and if the mortgage rates drop, you can refinance. And the Rueth team is doing a no lender fee refinance through the end of 2025. Why? Because we believe in home ownership and we believe in you. Well, that's a quick update on what's happening right now. Nicole Rueth with the Rueth team. Hope you guys are off to an amazingly fantastic short work week. We'll talk to you soon.